You know that one secret that everybody thinks they know? That little piece of financial wisdom that's been passed around so much we all just assume it's true? Well, today we are pulling back the curtain on maybe the biggest one of them all.
Ah, there it is, 10%. The magic number. You've heard it, right? From financial advisors, in articles, probably from your uncle at a family barbecue. The stock market, oh yeah, it returns 10% a year. It's the number that entire retirement plans are literally built on.
Not even close. And you know what? Understanding the difference between that myth and the reality, that is the absolute key to actually building long-term wealth. All right, let's get into it.
Now, let's be super clear. That 10% number isn't some made-up lie. It's just, well, it's dangerously incomplete. It's kind of like describing a hurricane by only talking about the average wind speed for the entire year. You're missing all the important and kind of scary parts of the story.
So first, let's make sure we're all on the same page. When people say the market, what they usually mean is the S&P 500. Think of it like a big basket holding the 500 largest, most important companies in the U.S. It's really the best single yardstick we have for how the entire U.S. stock market is doing.
And right here, this is where the myth is born. Because if you actually look at all the data, starting from 1957 when the index became what it is today, and you average out all the good years and all the bad years, you get a number right around 10.15%. So yeah, the number is based on historical fact.
But here is the very first crack in that foundation. Just like Investopedia says, an average return sounds great, but it doesn't tell you anything about the journey. Getting that average completely depends on when you get in and when you get out. And, well, life doesn't really work in neat little averages, does it? Okay, so if the market averages 10%, but that's not what's actually showing up in your account, where did the rest of it go? Well, it is time to meet the villains of our story. I like to call them the return killers. Dun dun dun.
Let's talk about some math that, for some reason, they really don't teach you in school. That 10% number is a simple or arithmetic average. But your money, it lives in the real world of compounded returns. So, imagine you start with $100. In year one, you have a great year. You're up 50%. You now have $150. Awesome. But then, year two is terrible, and you lose 50%. You don't just lose the $50 you gained. No, you lose 50% of your new total, which is $75. You're left with just $75. The simple average of your returns was zero, but your actual return was a painful minus 25%. That's the first return killer. Volatility just eats away at your real gains.
All right, next up is the silent thief, inflation. This is the one we all feel every time we go to the grocery store, right? It's that invisible force that just makes a dollar today worth less than it was yesterday. Your investments might be growing, but if the price of everything else is growing just as fast, are you really getting any richer?
And you can see the impact right here in real numbers. That shiny 10% return, that's what we call your nominal return. It sounds great, but once you factor in inflation, once you account for that loss of your purchasing power, that historical return suddenly drops to around 7%. Just like that, almost a third of your gain is gone before you even did anything.
So, we know the average is hiding the truth. Let's take a look at what that ride has actually felt like for real investors over the years. I'll give you a hint. It is way less of a smooth rocket ship ride and much more like the wildest roller coaster you can possibly imagine. I mean, just look at this timeline. You get the incredible post-war boom, but then it's followed by this long, painful slog in the 70s thanks to crazy high inflation. Then, bam, the 2008 financial crisis hits and the market drops over 36%. That's followed by an amazing 10-year bull run. And more recently, we had that insane COVID flash crash and recovery, and then another big drop in 2022. The ride is anything but smooth.
So, you might be wondering, how often does the market actually hit its average of 10%? The answer is almost never. Here are just a few random years to prove the point. In 1995, it shot up over 37%. Then in 2002, it fell almost 22%. Back up 32% in 2013, then down 4% in 2018. The real market is a creature of wild extremes, not gentle averages.
Okay, so you might be listening to all this and thinking, wow, this is kind of depressing, but I promise you it's the exact opposite. This is empowering. Knowing the truth gives you a huge advantage over everybody else who's still out there chasing that 10% myth. So let's use what we know to build a much smarter strategy.
So what's the first thing our human brains want to do when we see that crazy roller coaster chart? We think, aha, I'll just be clever. I'll sell at the very top and buy back in at the very bottom.
This is called timing the market, and for pretty much everyone who isn't a supercomputer, it is a recipe for disaster. You're way more likely to panic and sell during a dip, and then you miss out on the best recovery days, which is where most of the long-term growth actually comes from.
The smarter way to play the game is actually a lot simpler. Step 1, open an account somewhere you trust. Step 2, instead of trying to pick winning stocks, you just buy one single fund that holds all 500 companies, something called a low-cost S&P 500 ETF or index fund. And step 3, and this is the real secret weapon, you invest the same amount of money on a regular schedule, no matter what. It's called dollar cost averaging, and it basically turns that scary volatility into your best friend. When the market is down, your fixed investment just buys you more shares for cheap.
And getting started has never been easier. These are just a few of the most popular funds that do exactly what we're talking about. They just track the S&P 500. They have super low fees, and you can buy them through any major brokerage out there. They are literally designed to make this as simple as possible.
All right, so we've officially debunked the past. But what about the future? Can we still count on getting that inflation-adjusted 7% return going forward? Let's see what the experts, the people who build these really sophisticated financial models for a living, are actually forecasting.
See, huge financial institutions like Vanguard use these incredibly complex models. This one's called the Vanguard Capital Markets Model, to try and forecast potential returns. It's not a crystal ball, but they look at everything. Historical data, interest rates, economic trends, to create a range of likely outcomes, not just one single magic number.
And here is the really important takeaway from their latest model. For the next decade, their outlook for U.S. stock returns is actually lower than the historical average we've been talking about. Now again, these are just projections, they are not guarantees. But the main takeaway for us, it's probably a good idea to set our expectations realistically, maybe even a little more conservatively. That's the smart path forward.
And that really is the heart of it all. The goal isn't to get stressed out chasing some mythical 10% number every single year. The goal is to understand the real number, the one that's been adjusted for inflation and roller coaster like volatility, and then just have the discipline and the patience to stick with your plan and let the magic of compounding do its thing over time.
So I'll just leave you with this one question to think about. Now that you're in on the secret, now that you know the real numbers behind the myth, how does this change the way you think about your own financial future? This isn't about being pessimistic, not at all. It's about being smarter, being more prepared, and ultimately being a much more successful investor.